Hello, my name is Pablo, and today we'll be talking about the Home Depot Incorporated Analysis Financial Report. Uh, just to be clear, this is the fiscal year that ended in January 28th, 2024. Um, what are the company's total assets at the end of the most recent annual period? So the company's total assets at the end is the most recent annual reporting, which was recorded 76,530. But just to be clear again, um, this item is recorded on page 38, so you can see the whole list of financial report and balance statements as well. For example, net sales was recorded as $37,257 in credit, while cost of sales was reported as $23,985 in debit. So, in order to understand the curve, we would have to display the price per unit sold on the y axis and the quantity of goods provided on the x axis. So, you may ask, why is this important? For several reasons, including but not limited to financial health, investment and comparative analysis indicator of a company's financial strength stabilizes the investment attractiveness because it provides the valuable insight for the investors, creditors, and managers. So while stakeholders have that option, they can decide either to buy the stock or sell it for a price if they have the ownership of that. Key element of this important analysis is for several reasons, including not limited to financial health, investment and comparative analysis, credit worthiness, and liquidity. Overall, the total assets is an important attractiveness because it provides valuable insight for the investors, creditors, managers, and other stakeholders when assessing the company's financial position, performance, and prospects. Now let's talk about liquidity ratios. So the current ratio is calculated by dividing the total current assets by the total current liability. So as you can see, uh, the formula displays current ratio equals current assets divided by current liabilities. And in this example, um, the current assets is at the top and current liabilities at the bottom. You calculate that and you see the ratio. Pretty simple. Um, so for acid test quick ratio, this would be more constricted measure to meet the company's short-term obligations and is calculated by dividing the current assets minus investor by current liabilities. Now for profitability ratios, we're gonna look at asset turnover. In order to calculate the asset turnover ratio, we have to divide the net sales by the average balance of total assets. They had a total of 169 millions in net sales, and the total assets at the beginning of the fiscal year there were $76,000 $445, and at the end of the fiscal year, you can see the total assets is 76 as well. So you could see that the result turnover rounded up to 2. Um, that just gives you like a profit margin of the financial ratio. So if it's worth it or not to make the investment, this just expresses the result as such. Solvency ratio. Uh, the position of assets in axis of liabilities is the ability to pay one's debt. That's the definition of that term. So the ratio is to measure the total debt of a company's has in relation to its assets. It is calculated by dividing the total liabilities by the total assets, and then we express the result as percentage. Times interested earned. The ratio has easily repeat. What do liquidity and profitability and solvency ratios reveal about the company's financial position? Analyzing the profitability and solvency ratios provides a comprehensive view of a company's financial health. The current ratio above 1 indicates that the company has more current assets than the current liabilities, suggesting it can cover its short term obligations. However, the slight decline from 1.41 and 1.35 suggests a decrease in liquidity over the year. The asset test ratio, significantly lower than the current ratio, indicates when excluding inventory and the company has fewer liquid assets to cover its short-term liabilities. Despite an improvement from 0.33 to 0.4, this still indicates potential liquidity concerns if the inventory cannot be quickly converted to cash. A profit margin. A profit margin of 9.92% indicates that the company retains almost 10 cents of the profit for every seller. As a financial accounting consultant recommended to an outside investor to invest in this company, I would advise someone to maybe not put all of their money in one basket, but you know how the saying is, don't put your eggs in one basket. You gotta have a balance. So, risk tolerance. Investors must evaluate the risk and investment objectives. Investing in a company with high debt levels entails a higher risk, particularly in volatile market conditions. Investors with a higher risk tolerance may be willing to accept this risk for potential returns. Long-term viability. Investors would assess the company's long-term viability and growth prospects. Consider factors such as interest trends, competitive positioning, and management strategic initiatives. Evaluate whether their company has a solid business and a model for potential for future growth. Um, and lastly, valuation. Accessing the company's um, relative insight information about how they're performing is another benchmark. Um, Determining whether the stock price reflects the company's intrinsic value and future growth potential, and consider conducting a thorough valuation analysis determining the investment's attractiveness. All right, so based on these factors, recommending an outside investor to invest in this company would require lots of a comprehensive analysis of its financial industry dynamics and risk factor. And investors should act cautious at all times, not act smart, basically. Um, Professionals are trained for this kind of thing, so maybe it would be a good idea to find a risk. No, no, no.